Hello everyone. Welcome to Brilliant Bankers. In today's session, we'll be discussing about the funding and the regulatory aspects of RBI, which is about how the RBI controls the liquidity in the market, its functions as the lender of last resort, and also the payment and settlement systems in the banking system in India. We'll be going about a brief discussion about the payments and settlement systems in the banking system in India also. So, what does RBI do to regulate the money, or how does it do its funding? For funding, as you all know, RBI is the note issuing authority in India. That is, a currency in circulation is directly being controlled by the RBI. However, the currency is only the cash component of the money in circulation, and in that, it is only a small part of the total economy. So, current cash is only a small part of the economy that is in circulation, or the currency that is in circulation, which is being deposited in banks and then further lent out as loans, which in another way comes in as a deposit and being lent out as a loan. For example, let's take the case of Mr. A, wherein he comes to a bank with an amount of rupees 1 crore, and he asks that, or he wants to deposit that amount. In a day or two, Mr. B approaches the bank in request of a loan of rupees 75 lakh for his business purposes. So bank, after all their processes, they decide to lend the amount of rupees 75 lakh. So what has already happened is 1 crore has come in as a deposit for which the bank is going to pay the interest to the customer, and now Mr. B is taking a loan of 75 lakh for which B will be paying the interest to the bank. B, on his business purposes, pays the amount to Mr. C, and now Mr. C approaches the bank with rupees 50 lakh in his hand for a new deposit. So the base value, which was only 1 crore, has changed into 2.25 crores now. So this is called a money multiplier effect, which happens in the bank. So the cash or the currency part is a small area, but the money multiplies in the bank, which is not even printed. So this is called a money multiplier effect. And the currency that is being circulated, or the money that is being circulated, wherein it is not the currency or the cash, but it is a money on a whole that is being circulated, it is called as a broad money, which includes the currency in circulation and also the time and demand deposits that are available in the banks and the post offices. The monetary policy that is being brought out by the RBI is mainly aimed in controlling the inflation and ensuring the stability of the financial markets. So that the purpose of the RBI is to exercise control over the currency or the money circulation and reduce the money multiplying effect, due to which there is a very big problem called the inflation. As and when there is a money multiplication, each and every person will be having a lot of money for the purpose of rotation. He doesn't have any cash in his hand, but there is some kind of rotation that is happening. He automatically goes for a purchase of some kind of thing where demand is increased, due to which the price rises. So automatically the RBI has a control over the currency or and reduce the money multiplier effect. Wherein the RBI has instructed the banks to comply with certain requirements, like that of the CRR, that is a cash reserve ratio, and the SLR, the statutory liquidity ratio, by depositing cash in RBI and by investing in the government and or the approved securities, both in the government securities and some approved securities by the RBI respectively. So let's see what the CRR and SLR means. CRR, the cash reserve ratio. It has been defined under Section 42(1) of the RBI Act and Section 18(1) of the BR Act, wherein CRR is defined as it is the amount of fund that all the SCBs, that is the scheduled commercial banks, are required to maintain with the RBI. So CRR is the share of the bank's total deposit that is mandated by the RBI to be maintained with the RBI as reserves in the form of liquid cash. So in this condition, all the banks are to maintain a certain sum of money as liquid cash with RBI. On the current date, the CRR, that is as per the RBI, is 4.5%, which has been decided in the monetary policy of this year. So how does the cash reserve ratio work? When the RBI decides to increase the cash reserve ratio, the amount of money that is available with the bank reduces. This is the RBI's way of controlling the excess flow of money into the economy. So when the cash in the bank reduces, automatically the loans are reduced. The interest rate of deposits are reduced, wherein the cash flow towards the economy is being reduced. Here, the cash balance that is to be maintained by the scheduled banks with the RBI should not be less than the 4.5% of the total net demand and time liabilities, which is done on a fortnightly basis. The check for the NDTL is done on a fortnightly basis. The NDTL that refers to the total demand and the time liabilities that are held by the banks. It includes the deposits of the general public and the balances that is held by the banks with other banks also. So, what is net demand and time liabilities? This is the total deposit that is held by the public in a bank and the same bank holding a deposit in an other bank. So demand deposits consist of all the liabilities which the bank needs to pay on demand, like that of the current deposits, the demand drafts, the balances in the fixed deposits or the fixed deposits that have been matured, and also demand liabilities portion of the savings bank account. It can be withdrawn at any time. So time deposits consist of the deposits that need to be repaid on the maturity and where the depositor can't withdraw the money immediately and where he can also reinvest the same. Instead, he is required to wait for a certain period to gain the access to the funds because of the maturity period. This includes the fixed deposits, the time liabilities of the SBA deposits also, and the staff security deposits that are being made. The liabilities of the bank include the call money market, borrowings, certificates of deposits, and the investment in deposits in the other banks. In short, the higher the cash reserve ratio, the lesser is the amount of money available to the banks for lending and investing. In this case, the CRR is one of the main components of the RBI's monetary policy, which is used to regulate the money supply, the level of inflation, and also the liquidity in the country. The higher the CRR, the lower is the liquidity with the banks, and whenever it is lower, the liquidity is always higher. So, higher the CRR, the lower the liquidity, and the vice versa. During the high levels of inflation, attempts are always made to reduce the flow of the money in the economy. So, this is what the RBI does whenever there is a hike in inflation rate. So, how does the CRR affect the economy? How does the cash reserve ratio affect the economy? In this case, the RBI increases the CRR, lowering the loanable funds available to the banks. So, in turn, it slows down the investment also and reduces the supply of money in the economy, which, as a result, or wherein the growth of the economy is negatively impacted. However, this also helps bringing down the inflation. But on the other hand, when the RBI wants to pump funds into the system, it lowers the CRR, which increases the funds or the funds, loanable funds available with the banks. The bank in turn sanction large number of loans to businesses and the industry for different investment purposes also. It also increases the overall supply of money in the economy. This ultimately boosts the growth rate of the economy. So this is how the CRR works, and this is how the RBI regulates the CRR, and this is the main reason for regulating the CRR. So what is an SLR? The statutory liquidity ratio. This is the minimum percentage of deposits that commercial banks maintain through gold, cash, and other securities. This is the liquid fund that should be available with the bank. However, these deposits are maintained by the banks themselves and not deposited at the RBI. So in this case, the banks they should have in a liquid state at any time. Let it be gold, let it be cash, or the other securities, that is the government securities or the approved securities by the RBI in their hand. And this is always maintained at the banks themselves. And on date, the current SLR that is being maintained in India is 18%. How does the SLR work? In this condition, every bank having a particular portion of their NDTL in the form of the cash, gold, and other liquid assets by the end of the day. The ratio of these liquid assets to the demand and time liabilities is called the statutory liquidity ratio. The Reserve Bank has authority to increase this ratio up to 40%, wherein on date it is 18% only. And an increase in the ratio constricts the ability of the bank to inject more money into the economy. RBI is also responsible for regulating the flow of the money and the stability of the prices to run the economy. Statutory liquidity ratio is one of the many monetary policies for controlling the inflation again. So SLR, among other tools, is instrumental in ensuring the solvency of the banks and cash flow in the economy. How does it help in the solvency of the bank? So if there is any closure of any deposits in premature case or any other condition or on maturity, if in case the bank is not having any fund, how is it going to clear those deposits? So for that, there should be liquid fund available in the banks at all time. And whenever the SLR is increased, which is currently 18%, if it is increased to 40%, again what happens is the bank should hold that amount of its total deposits with him. So out of 100%, when 40% is being held with us, only 60% can be given back to the market or on or as loans, due to which the cash flow has been reduced. So this is how the CRR and SLR helps in reducing the inflation and helps in controlling the economy of the country. So what happens if the SLR is not maintained? If in India, every bank, such as a scheduled commercial bank, state cooperative bank, cooperative central banks, and the primary cooperative banks, all are maintained, all have to maintain the SLR as per the RBI guidelines. For computation and the maintenance of the SLR, banks have to report their latest NDTL to the RBI every fortnight. That is on a Friday. Every Friday's fortnightly basis. If any commercial bank fails to maintain the SLR, in that condition, the RBI levies a 3% penalty annually over the bank rate. And if the defaulting happens on the next working day also, it will increase to 5% fine. This ensures that commercial banks do not fail to have ready cash available when the customers demand them. So this is the main reason for maintaining the SLR. Whenever the customer demands for money or for their deposit or on the closure of the deposit, they have it always in their hands. So coming to what are the components of these NDTL? We have been telling the word NDTL, the net demand and time liabilities. So what are the components of the NDTL? NDTL can be divided into two parts. There is a demand liability and a time liability. Now let's go into the demand liability table. Components of a demand liability are the current deposits, the demand liabilities portion of the savings bank account, the margins that are held against the letter of credits and the guarantees, the balances in the overdue of the fixed deposits, cash certificates, and the cumulative and the recurring deposits, that is the term deposits. If there is any outstanding telegraphic transfers or the mail transfers, any unclaimed deposits come under the demand liabilities, and all deposits held as security for advances which are payable on demand. So anything that has been on a term period or as a savings bank account or any cash in a savings bank account or anything that has been put out as a letter of guarantee or letter of credit all comes under the demand liabilities. So what is the time liability? Time liability of the bank shall include those liabilities which are payable otherwise than on demand, and they include the fixed deposits, that is it. Again, the term deposits, these are paid only after the completion or the maturity of the term, that is the fixed deposits, the cash certificates, the cumulative and the recurring deposits, the closure period of the amount in an SB whenever it is going for a closure, if there is any security deposit from the staff, any margin that has been held against that of the letter of credit. So all these things, the demand liabilities and time liabilities are almost similar, but the time level liabilities come in the condition only when there is a maturity of all those deposits, and demand liabilities are wherever there is a kind of payment that is to be done. For in case if in a deposit there is a monthly or a quarterly interest payment to be done, in that condition it becomes a demand liability for the interest portion of that deposit, but not for the principal portion of the deposit. So coming to the next topic, that is the liquidity adjustment facility. So what is a liquidity adjustment facility? It is a principal operating system of the monetary policy. It is a monetary policy tool that is being used by the Reserve Bank of India to manage the short-term liquidity in the banking system. It is designed to help banks maintain an appropriate level of liquidity and to control the money supply in the economy. The liquidity adjustment facility consists of two components mainly, that is a repo rate and the reverse repo rate, which we have been learned a lot. Being a banker, we all know what is a repo rate and what is a reverse repo. So let's have a clarity on the same again. The repo rate, the term repo as defined stands for the repurchase agreement. In a repo transaction, the RBI buys the government securities from the bank with an agreement to sell them back at a future date. Banks use these transactions to borrow money from the central bank. So the repo rate is the interest rate at which the RBI lends money to the commercial banks against the collateral of the government securities. If the RBI wants to absorb liquidity from the system, it increases the repo rate, making it more expensive for the banks to borrow money from the RBI. So we can say it as the rate of interest at which RBI lends money to the commercial banks. So whenever the repo rate increases, it becomes difficult for the banks. It doesn't become difficult for the bank, but there is a thing that whenever the interest increases, the loan decrease. So automatically, whenever the repo rate increases, normally the lending rate also increases, and here the banks have to pay more interest to the Reserve Bank of India. On date, the repo rate stands at 6.5%. So what is the reverse repo rate? This is the opposite of the repo rate. In a reverse repo transaction, the RBI borrows money from the banks by selling government securities to them, or it can be told as it is the acceptance of the surplus from the banking sector. Whenever there is a surplus in the banking sector, the RBI accepts it It can be also defined as the acceptance of the surplus, or the borrowing from the banking system. The reverse repo rate is the interest rate at which the RBI borrows money from the commercial banks. If the RBI wants to inject liquidity into the system, it decreases the reverse repo rate, encouraging banks to lend more money to the central bank, which stands at the 3.35% on it. So banks can participate in the LAF auctions, that is the liquidity adjustment facility auctions, that are conducted by the RBI to manage the short-term liquidity needs of the banks. And the condition is that the auctions are for a minimum amount of rupees 5 crore, and it's always in the multiples of that amount. So by adjusting the repo and the reverse repo rate, the RBI can signal its monetary policy stance. For example, whenever there is an increase in the repo rate, it can be a measure to control the inflation by reducing the money supply, while decreasing it can stimulate economic activity by making the borrowing cheaper. The LAF therefore provides a mechanism for the RBI to regulate the liquidity in the financial system and achieve its monetary policy. So, coming to the same condition, what we have learned in the previous slide, the CRR, the SLR, and now the LAF, all are used for the control of the currency or the money in the market, to control the monetary system and as per the monetary policy. So there are two types of repos. One is called the overnight repo, and the other is the varied rate repo. So what is an overnight repo? It is a liquidity that is being provided by the RBI at the LIF repo rate. In this type of repo, the RBI fixes a fixed repo rate at which it is willing to lend to the banks, and banks can borrow as much as they need at that rate. The RBI commits to providing funds to the full amount demanded by the banks. Hence, the term is also called full allotment. That is for an overnight period. This type of repo is used to meet the liquidity needs of the banks. There is also something called the variable rate repo. In this kind, the RBI does not fix the repo rate. Instead, it allows the banks to bid for the funds at the rate they are willing to pay. In this condition, the rate, there is a fluctuation. The RBI then decides the cutoff rate, and all successful bidders should pay this rate. This type of repo allows for more flexibility in determining the cost of the funds for the banks. Coming to the final topic, that is the payment and the settlement systems in India. Payment and settlement systems play a vital role in the development of the financial market. The important reforms relevant to the treasury operations in the case of the payment and settlement systems are that the payments that refer to the interbank payments as also payments on the behalf of the customers. So payment refers to the interbank payment. In this condition, in the payment and settlement system, all the payments, the word payment refers to the interbank payment of the customers, that is the payment from one bank to the other. And the settlement, the word settlement refers to the payment or receipts in the exchange of the securities or the foreign exchange. Conventionally, the interbank payments have been handled by net settlement through the clearing houses. Nowadays, it is being carried out through the clearing houses through the net payment system, that is whenever in batches. Earlier, the same used to take 1 to 3 days or even longer if the payments were out of station kind. Also, having a probability of a counterparty risk, and also the expensive delays in the check collection. That is, if there is a problem in the collection of the check, that is, the signature is mismatched. The check used to go and come back after 15 days. The person who has deposited in his account He will be waiting for those 15 days for his check to go to that branch, get it cleared, and then come back. He will be getting the news that his check has been bounced, and it's almost 15 days. So there was a delay also, where the person was also losing his interest. And this also, there was also an operational cost of handling the paper based check clearing, which was high due to the postal charges that used to be there. Nowadays, this has changed into the internet banking system, and you do have new developments like that of the RTGS, the negotiated dealing system, the foreign exchange clear system, the depository institutions that help you out in payment and settlement systems, the NEFT and the online payments. So let's go on these topics on a brief note. The developments in the sector are initially with the RTGS, the real time gross settlement, where an RTGS is an electronic fund transfer system that enables the real time one to one fund transfer between banks on a gross basis. It ensures that the transactions are settled individually without bundling or netting with any other transactions. Usually, the RTGS is typically used for high value transactions, minimum of rupees 2 lakh in amount, wherein the transfer of funds needs to be instantaneous and irrevocable. It is commonly employed for a large value interbank transfers and also customer transactions. What is a negotiated dealing system? The negotiated dealing system is an electronic platform used for trading in the government securities and other money market instruments. It also facilitates the secondary market trading of the government securities. It is used, the NDS provides a transparent and efficient platform for market participants, that is, including the banks and the financial institutions, and also the primary dealers to buy and sell the government securities. What is an FX clear or the foreign exchange clear? It is a platform for clearing and settlement of the over the counter foreign exchange derivatives in India, which is being operated by the CCIL, that is the Clearing Corporation of India. So it is a over the counter foreign exchange settlement process. The FX clear plays a crucial role in mitigating the counterparty credit risk in the forex derivative market. It also ensures that the safety and the efficiency of the clearing and settlement processes for these instruments. The depository institutions in India, like that of the NSDL and the CSDL, provide depository services for securities. They even hold the securities in electronic form, that is in a demat form, and enable electronic settlement of the trades in the stock market. These institutions help in dematerializing electronic trading and also safekeeping of the securities, reducing the need for any physical share certificates. Coming to a final topic, the NEFT or the National Electronic Fund Transfer. It is an electronic fund transfer system that operates on a deferred net settlement basis. It facilitates fund transfer between banks across the country all throughout the 24 hours in a half an hour netting basis. NEFT is commonly used for the retail transactions, including the individual and corporate fund transfers. So transactions are processed in batches and settlement occurs at set intervals of every 30 minutes. So these systems and institutions collectively contribute to the efficiency, transparency, and the safety of various financial transactions, covering such as security trading, funds transfer, and also the foreign exchange. Each serves as a specific purpose within the broader financial infrastructure of our country, that is India. So, with that, we have come to the end of today's session, and we have discussed about the different types of funding and regulatory aspects of RBI and the different payment and settlement systems in the country. If you have any questions or comments, please feel free to leave them in the comment section. Your feedback is very invaluable to us. Do not forget to like, share, and subscribe our channel, The Brilliant Bankers. Until next time. This is Nishant signing off. Jai Hind.